Dear students, this is T.Prabakaran, Assistant Professor, Department of Commerce, St.Joseph's College of Arts and Science, Autonomous, Cuddalore. In this video, we are going to discuss about the topic Profit Prior to Incorporation. First of all, that you are going to understand the topic. What is meant by profit prior to incorporation? In general, the profit is the result of the business operation. The business operation may be either profit or either loss. So here the profit is the output of the business operation. Prior means before. Incorporation means registration. So in the topic itself, we can able to understand that profit before the registration. The registration means the registration of the company. Usually the company is come to the existence only after the incorporation or registration. According to the Companies Act 1956, in India, if any company which has to be formed, it has to be registered under the Companies Act 1956. After 2013, it has to be registered under the Companies Act 2013. So we are going to understand the meaning of profit prior to incorporation. A company come into existence only after incorporation or registration. A private company or public limited company can commence its business only after obtaining the certificate of incorporation or registration. Thus, any profit earned by the company before the date of registration or incorporation in case of public and private limited company is called profit prior to incorporation. So according to this meaning, we can able to understand that the profit which is earned by the company before its incorporation registration is termed as profit prior to incorporation. We are going to see the treatment of different items or ratios applied. In profit prior to incorporation problem, the steps which are involved. The step number 1, the calculation of ratio, which is time ratio, sales ratio, the adjusted time ratio for interest paid, the weighted time ratio for salary, wages paid, and these are the ratio has to be calculated. The second one, we need to prepare the notes to account for allocate the expenses in between the period of pre and post incorporation. And third step number, the preparation of statement of profit and loss for the year. So in this statement, we are going to divide the profit in pre as well as the post. We are going to see the treatment of different item or ratio applied. First of all, the gross profit or the gross loss, which will be allocated, which will be apportioned based on the sales ratio. Then second one, all the fixed expenses or the time related expenses like salaries, rent, taxes, insurance, depreciation on fixed asset, postage and telegram, printing and stationery, general expenses, office expenses, electricity charges, lighting, miscellaneous expenses, audit fees, bank charges, interest on loan, establishment expenses, administration expenses, office expenses, repair, and all the time related expenses. These expenses will be allocated based on the time ratio. And third one, all the variable, the sales related expenses like commission to salesman, discount allowed, discount received, bad debts, traveling expenses, selling expenses, salesman remuneration, bad debts and doubtful debts, carriage outwards and advertisement. This will be allocated based on the sales ratio. Then fourth one, the pre-incorporation items or expenses like partner salary, commission, the remuneration to the partners, manager's salary, bad debts recovered, interest paid on capital, and all the expenses related to the pre-incorporation period that will be directly allocated in the period of pre-incorporation. Then fifth one, the post-incorporation items or expenses, which are the preliminary expenses. It also known as formation expenses, director fees, company secretary salary, managing director salary, underwriting commission, donation given, discount on shares and debentures. These will be allocated based on the post-incorporation period. And finally, the adjustment items like the expenses which are given in the problem with detail like interest paid to vendor, increasing the rent, increasing the wages after the incorporation. This will be allocated based on the actual ratio according to the information given in the problem. This is now we are going to see the statement of profit and loss for the year ended. So this is a pro forma in which we are going to record all the expenses and incomes by which we are going to ascertain either profit or either loss. So this is the pro forma. The first one, serial number, particular, note number, total, pre-incorporation period and post-incorporation period. The first one, the revenue from operation. Then second one, other income. So revenue from operation, other income, altogether that will be taken as total A. Less expenses, cost of goods sold, finance cost, employee benefit expenses, depreciation and amortization expenses, other expenses. These all the expenses will be categorized under the head of total expenses, which is called B, total B. Now we are going to comparing the income and expenses. A minus B, we are going to get the profit for the year. So here we are getting the profit. That profit can be ascertained for the pre-incorporation period as well as in the post-incorporation period. So this is the pro forma. We are prepared for the profit prior to incorporation. So we are going to see the one problem in the next video, how to ascertain the profit prior to incorporation. Thank you, my dear students.